So a final thought on this note, on this particular point, is how I've used this in the past. Um, a while ago, I had a few credit cards. They weren't at 25% because I'm great at negotiating with credit card companies. And in a previous episode, I think I talked about how you can negotiate them down. But I didn't like having those credit cards, and I'll borrow from the broker, and then I will drop it into the credit card. And so that was a guaranteed return for me, the difference between 2% and what I was paying on the card. The reason it was safe for me to do it is that I have capital sitting in a bank account that if I ever get a margin call, I can pay off the whole debt without any problems. So my portfolio will never be at risk. It is an advanced strategy to use margin at all, so don't just do it. But it is something to consider and a great way of leveraging. Always pay the highest interest rates, and if you can get a lower interest rate somewhere else, swap that out. So that's one more way of doing it. The other way of using margin, and this is the next thing on the list, is if you're a wealthy individual, high net worth individual, is what they call it. If you're an accredited investor or a qualified purchaser, if you're on those higher tiers, don't go spending selling stock to buy that yacht or car or a holiday or whatever. Use margin. Borrow that money off of that because basically when you sell the stock, now you got to pay tax on the stock. If you borrow the margin, the interest rate's so super low, not nearly what you'd pay in taxes, and there's no tax on when you borrow money. You don't have to pay tax on that. And then when you pay back that margin from your cash generative business, you don't have to pay tax on that money because paying off loans is something that you do without having to pay taxes. So you can avoid taxes almost entirely by playing with margin. So that's another way of increasing your returns because you're not selling your stock. So that's the next point. What do you think of that?
Yeah, as we spoke previously on the last couple of episodes, this is a really useful technique which wealth people use in order to optimize their spendings and decrease the amount of taxes they pay. Of course, it is also advanced strategy, and this can be risky because you also use your stocks as the collateral. As Nick said in previous example, it is great then you have the cash sitting on the bank. Besides that, in order to cover the losses if they can occur, of course. But you will definitely can receive lower rates and pay less taxes in this case.
The next one's a little simple, but a lot of people seem to miss it. I did mention it once in one of the other episodes, but it's good to pull it all together here. If you've done your calculations and you feel reasonably certain that you've got two companies that are going to both grow at 10%, the price with, in the next year, it's going to go up 10%, the year after 10%. That's your kind of estimations. If you feel relatively strongly about they're equal in growth, in price and expectations over the next 5 years. But you want to know what's the tiebreaker, how to get that extra little bit of a yield on your growth of your money. If the companies are pretty much identical in all ways, but one of them's got like a 3% dividend, it might not seem like much of a dividend, but if you take that 3%, you add it to the 10%, your money's actually growing at 13%. People don't seem to think about that, but you add those two numbers together, and that's your real growth rate of your capital. So think about that, add that in. What do you think of this one?
Obviously, most great companies can pay dividends, or they can buy back their shares or pay the debt. Eventually, you will receive the increase in price. But dividend is the pleasant bonus which we can use, and this works with indices or growth companies as well. It depends on the industry.
That's a great thing you brought up, buybacks. You should think about that equally to dividends, if not better. When they do buybacks regularly, it actually means that your percentage of the company that you own is growing every time. And so over a period of 20 years, you might have double the amount of percent of that company or more than when you started. So definitely think about that as well. That's a big one. All right, so moving on, my final one I want to add before I ask Eugene what he's got on the ideas for this particular episode. This is a very exciting one. Now, very advanced. This one I do not recommend for everyone. But if you're an expert investor, if you know your stuff, if you know you can get great returns every year consistently for the next 20 years, if you love investing, if you can get, say, an average of 15% even or higher, people will want you to invest their money. And this method of making significantly better returns is called other people's money. And effectively what it is there's a limitation to the amount of money you can make with only your own money, because it's always going to be a percentage of the money you're investing in. If you've got a limited amount, you're very limited with your own money. That's the maximum you can make. But as soon as you're investing other people's money, now you've got 10 times more money, 20 times, 100 times more money to invest. Your personal returns from investing other people's money, it's staggeringly more money than what you could have made with your own. So you're going to need to set up a fund, and you're going to get your legal docs, and you're going to pitch the investors, find some capital raisers. But effectively, this is the number one way of increasing your actual returns far beyond anything you could have done any other way. No matter how much of a genius you are, the returns you make on other people's money, because you're getting a percentage of the pie, whatever it is you negotiate with, this is the number one way, I think, really ramping up your returns. It's a little scary, a little daunting, probably one of the hardest things to start as a hedge fund. But if you're an expert investor, can't recommend it enough, because it's an incredible way to really, really ramp up your earnings. Over to you, Eugene. What do you think of that?
Well, I think this is a really great point. We both have the same aims to create funds because we really love idea of investing, and we can just scale this thing up. And we think, and I personally also think, that we can bring value to other people just by doing what we love. And when you understand all these things, you really can have higher returns than the market average. You will be receiving more offers from investors with the money. And eventually, this is the way of increasing the value and earning more. This brings us to the next thing, which you also can just optimize and be very careful about. And it's not for like the advanced people, but for ordinary and beginner investors as well, is you need to think about the fees and commissions. Because if you invest in indices or stocks or hedge funds, they usually have some kind of the commission. So when you buy the stock, you have the commission from the broker and different fees. When you buy indices, you have the management fee and the year fee for all of that. And also when investing in a hedge fund with a hedge fund manager, you also have the management fee and the annual fee as well. You need to see and calculate very carefully and know all these fees and commissions, because eventually these are percentages of your money. And in 80-90% of the cases with the hedge fund managers, they can charge you like 2% annual fee based on your assets which they manage. In our case, we will go away from these annual fees completely. So we will be charging from the performance, our performance as the hedge fund managers. But you also need to calculate that, because extra 2-3% every year is like doubling your money in 26 years. If you are really long-term investor, this is a significant portion of the money. What do you think about that, Nick?
I think that this is a very good point. A lot of people don't want to spend the time managing their own accounts. So they go to maybe their bank, and their bank is basically going to put them onto some kind of mutual fund or some kind of plan where 2% of the portfolio, whether it performs well or badly, will go to the bank or mutual fund. And 2%, whether you do well or badly, is disgusting, because as we've said, over a 24 or 26 year period or something like that, you're losing 50%. That's a lot of money, because it adds up and compounds. If you are with someone with a 0% management fee, and they only get paid on performance. And if that performance is beating the benchmark S&P 500, then they deserve the money that they're getting, because 95% of money managers are not beating the S&P 500. So I would say look for someone with a 0% management fee. Look for someone who's consistently beating the S&P 500, and compare them with others. And if you like what you see, give them a try. You can always take your money out if they're not performing to your liking, or if there's a better offer on the table. Just remember, it's better to invest with long-term investors than short-term, because the list on the Forbes showing the richest people in the world, the top 100 people, there are many long-term investors, and there are no short-term investors. That should tell you something.
And this brings us to the next point, which is suitable for beginner and all types of investors. And if you still want to be an individual person who invests in stocks, this method is called dollar cost averaging. So, for example, imagine the situation: you go and purchase the stock which you really like, and due to these economic fluctuations, you see that next day or next week the price dropped like 10%. So you can just buy more of your favorite company. And by doing that, you lowering the average cost of the purchase. So in this case, even if you started with a higher amount of the price for this particular company, you will create more margin of safety, and this can help you to earn more. Usually, most people just recommend to split your portfolio, and you split your money which you would like to invest in the particular company for several parts. You just start with investing the first part, then you just wait for some time, and then you just add another parts to the particular price, whether it's decreasing or increasing. What do you think about that, Nick? I think it's really useful stuff for our audience.
Totally agree. In fact, some of my favorite investors, what they do is they'll decide how much money they want to put into a stock. Let's just say 1,000, and then they split that into 4 or 5 pieces. So say 250 per piece. And then when it hits the margin of safety, that's 50% lower than the intrinsic value, they'll put in just that first chunk, 250 in. And then they'll watch, and if it goes down another 5% or 10%, whatever they've decided, that's when they'll stick the next chunk in. And they'll wait, and if it goes lower, they'll put the next chunk in. And they try a little bit of judging. If it starts going up again, they'll put the rest in. But effectively, there's kind of an unspoken law that doesn't have a cool name, but effectively, a lot of investors have found when you put your money in, that's when the stock will go down further. And so this kind of protects against that, so that when it does do that, you can buy it at an even lower price. It's important not to chase the lowest possible. I've seen a lot of investors, even friends of mine, when it's almost at that price that they were set to buy, they'll then lower their buying price even lower and end up never buying the stock. You gotta it's called tranching or tranching. You gotta tranche your way in with these little chunks to make sure you actually do get into the stock. But it's a kind of a slightly fun game, trying to get the best possible price, lower your basis. Your basis is effectively the average price you paid for a stock throughout all your buying and selling. So you want to lower your basis as much as possible. It's not really strictly dollar cost averaging. It's more lowering your basis, in my opinion. Dollar cost averaging is kind of never looking at the price value combination, never making a judgment, just setting it on auto with your bank and going, I'm going to buy stocks every month the same amount without looking at the stock for the next 2 years. That's kind of dollar cost averaging. Sometimes you buy it too high, sometimes you buy it too low, and you're kind of averaging the market. That protects you in some ways, but it's really, to me, I want to know that I'm buying it on a sale at all times. But yes, the basic concept is there to put it in pieces and do it to lower your basis as much as possible over time. So I do like that method a lot. That's a good one.
So the final and last advice which we probably can give to our audience is to be a really intelligent investor. Don't be affected by the hype. or the something to buy which you heard from the friend or colleagues on work or just in random news article or blogs, because usually such type of companies are overvalued. There can be, of course, different reasons, but in most cases you can be really in trouble to purchase these shares instantly. You need to conduct your own personal research, understanding the business, talking to managers, watching their interviews, talking to maybe customers, employees of this particular company in order to understand whether this is a really great business and whether it is undervalued or fairly priced. And it will save you a lot of money in the future. But anyway, this is all for today. We hope you really enjoyed this episode. If you have any questions, please write them down in the comments below, and see you next time.